Everybody, this is Mike DeSepoli. Welcome to the Heritage Insider Weekly Market Report for Tuesday, January 11th, 2022. Hope you're all having a good start to the week. Markets are having a good day today. More importantly, we've seen some developments in the markets over the last couple days that we think are worth noting. We want to take you through those here today, as well as give you a little bit more context around this constant narrative around interest rates and what is the Fed going to do and when are they going to do it and how fast are they going to do it. We think that there is a big divergence between what the Fed is saying they're going to do and what they are actually going to do. We believe we have some data here to back that up today, so we're going to take you through that as well. So first, today in the markets having a good day. Fed Chair Jay Powell in front of the Senate today for his confirmation hearing, right, being reappointed back to the Federal Reserve Chair. And if you've seen a lot of these Senate confirmation hearings, most of them are political theater. It's already a foregone conclusion that he will be confirmed back to head up the Fed, but he took some question and answers today. And naturally, the senators, first and foremost, their questions were about inflation, whether that will be persistent or transitory, and what the Fed is going to do with interest rates. Now, just to, before we get into that, let's take a look at the markets. As of right now, we got about an hour left in trading here today on Tuesday. Dow Jones up 175 points, about 0.5%. The S&P up 31.6 points, about 2/3 of 1%. And the NASDAQ leading the way today, up 211 points, 1.42%. So good action in the markets. We know the NASDAQ has underperformed recently, late fourth quarter into early in 2022. We do think that's about to change in a big way, and we'll tell you why in a moment. But this is the type of pattern change that you want to see in the markets. And another pattern change that's quite interesting is, generally anytime Jay Powell gets behind a microphone, markets don't like it. We have a lot of history to back that up. There's a lot of trends that have persisted since he took over as Fed chair. So it's interesting today to see the markets maybe taking what he says with a grain of salt and being a little bit more easy about it. So let's talk about first what we think is a very important development that's happened in the markets just over the last couple of days. So let's take a look at the NASDAQ. Okay, this is looking at the NASDAQ over the last 6 months. Okay, we'll move that over. Now, when we spoke about this corrective range that we're in, right, we've spoken about it quite often, right, over the past couple of weeks. And some of you might remember, probably about 2 to 3 weeks ago, we spoke about what we felt was the maximum downside scenario for the NASDAQ, right? What's the worst case scenario? How low could the NASDAQ go? And we referenced a price level of 14,500 as what we felt was the bear case, right? The lowest the NASDAQ could go before the correction would find its footing and we would start to move higher. We did have a couple questions from some of you folks that said, we're intrigued by it and say, well, why 14.5, right? Of all the levels that you could pick, do you just pick a round number or is there something more to it? And what we want to show you is, A, there's always something more to it. And B, we want to talk about why that level was important. Now, when you look at a market, right, generally markets tend to have continuation type trends, right? And very often do you see what's called a gap, right, where price gaps up and continues to run away. And there's a tendency in markets, and I won't get into it because this would be enough content for another video, but markets tend to create gaps and then work on filling those gaps, right? And it's a supply and demand thing in markets. And so when we look here, right, in this particular level, it doesn't look like much, but this was a gap created in the market. And we had a gap and the market ran higher. Now, there's a general school of thought that says the market at some point is going to come back and fill that gap. And just for some other examples, you can see other gaps in charts, right? Here's a gap down, the market came and filled that gap. Here's another gap down, and over here, the market filled that gap. So markets have a tendency to fill the gap, and we had a gap that was left unresolved. You guess where? Around the 14,500 range on the NASDAQ. So markets ran up, they've corrected, they pulled back and forth and back and forth, and yesterday we had a very sharp move down right into this gap, right, if you see how this lines up. What's more important about what we saw yesterday, and if those of you that watch the market very closely, the market at one point yesterday morning, the NASDAQ particularly, was down about 386 points and actually rallied to finish positive on the day. Now, that is a massive move off the lows, and a lot of times when we talk about a bottoming process, what it looks like is a sharp move down followed by a rally throughout the day. Add to it the rally that we're seeing today, and in a very short period of time, we've seen the NASDAQ move 600 points off the lows, which is nothing to shake a stick at. Now, again, it takes more than a day or two to mark a trend, to identify a trend, but this is why we pointed out that 14.5 level. We feel very comfortable with the way the market behaved and bounced violently off this level. We're getting some follow through today, and obviously we want to see some follow through until this index is pushing up to new all-time highs. And at the point that we do get that break above this level and we're in new all-time highs, there's much less overhead resistance, and we would expect the market to pick up some steam at that time. Now, what we want to talk about here for a moment is the expectations around interest rates. Now, Goldman Sachs came out yesterday and talked about expectations for the Federal Reserve hiking interest rates. Now, the initial thought process was the Fed might hike 3 to 4 times this year, and Goldman came out yesterday and told the world that they think the Fed is going to hike 4 to 5 times this year. Okay, so naturally, the market has to grapple with this new reality. More interest rate hikes mean more tightening of monetary policy, which in theory is supposed to be less stimulative or beneficial to stocks. Now, the first thing we have to say about Goldman Sachs is what they say publicly is generally the opposite of what they're doing privately. So number one, I don't actually believe that Goldman believes that they're going to raise rates 4 or 5 times this year. Now, again, this would be a topic for another day, but a lot of times institutions will tell the public one thing and they'll be doing something else. If that sounds like manipulation, it is, but it's a legal kind. So let me tell you why we don't think the interest rate increases are going to come 4 to 5 times this year. There's some obvious data that has occurred over the last couple months that has changed the paradigm that the Fed is in. So number one, when the Fed first started talking about raising interest rates, it was an expectation that we were going to pass a $3 trillion stimulus package, which did not come to pass, right? So that was $3 trillion of extra spending, which would have added to inflation, further making the case that the Fed needed to raise rates. So that was number one. That didn't happen. More importantly is consumer sentiment, okay? The University of Michigan puts out what I think is the best nationwide consumer sentiment survey, and this is a gauge about the level of confidence that the American consumer has in both their personal financials and the economy in a forward-looking manner. Now, if we look at the consumer sentiment survey over the last number of years, obviously we had a big dip in consumer sentiment at the onset of the pandemic. But then over the course of the last year and into April of this year, consumer sentiment was rebounding, and it was doing so quickly and had a lot of people feeling very confident that we were going to continue to see these type of sentiment gains. Well, in April of 2021, it looks like, at least in the short-term window, consumer sentiment peaked out. And actually, when you look where we're sitting today, as of the most recent reading, which it's always 1 month behind, so we're looking at data through the end of November, consumer sentiment sits today lower than people were feeling in March of 2020, which is really hard to believe when you consider it. But this is a very big barometer that the Fed watches, because remember, if consumers do not feel confident in the future, they hold on to their money longer, they tend to spend less of it, they'll invest less aggressively, and ultimately in a consumer-driven economy, that will create some headwinds for retail sales and consumer reports and the like. So the Fed is watching this, and we are making the case here at Heritage that we think the Fed will raise rates. Right? We'll give them one because they have to save face. They've spoken about it for so long. I think it's probably a given that they'll raise rates once, maybe twice. And that is our base case for this year. We don't think 4 rate hikes. We don't think 5. And we also think that inflation is going to start to inflect downward. Because remember, we have different types of inflation. You have inflation that's created in the supply chain, right? Supply-demand inflation. And you have currency inflation, right? Currency inflation is the result of printing more dollars in the last year than have been printed in the previous 15 years, okay? Raising interest rates will not fill up the used car lots that are empty right now. And those examples go far and wide. So the Fed knows that. The Fed knows that just by raising the benchmark interest rate, that it's not going to get them to a place where they're going to solve all of our issues. And we've monitored some of the stats in terms of port congestion. We're starting to see that come down as well. So we do think some of the supply chain issues are easing. And when you layer the threat of Omicron on top of all this, and the fact that business owners are again grappling with closures and staff shortages, we think this paves the way for a Federal Reserve that is going to look to still follow their plan, but they're going to do so much less aggressively and much less hawkishly, if you will, right? So to be, a little bit kinder to the economy, a little more stimulative. So for this week, what we're watching tomorrow morning, that's Wednesday morning, the Consumer Price Index, the monthly readout on CPI, which is the market's best metric for gauging inflation. Everybody expects that number to come in hot. We know it's going to come in above longer term averages, but the question is, does it come in slightly lower than last month and the month before? Which, if it does, will suggest that maybe the worst of inflation is behind us and it's starting to roll over. And that certainly would be a good thing for the market. So we'll be watching that tomorrow morning. But all in all, we like the activity that we saw on the NASDAQ this week, and the case could be made from other major market indexes as well, that they're starting to get to a point where we can put this correction behind us. And a lot of these depressed assets, which have really taken it on the chin through the course of the last couple months, as the fears of fast and furious interest rate hikes have been running rampant, we think those stocks will find their footing and lead us on the next leg higher. So if you have any questions, of course, always reach out to us. Always here to talk to you about anything that's on your mind. We hope you have a great day, and we'll see you back on Friday for the Heritage Market Pulse.